The Ethics of Finance, Balancing Profit and Responsibility. Welcome to our blog, where we explore the delicate balance between profits and responsibility in the world of finance. As we all know, finance is a powerful tool that can create immense wealth and prosperity for individuals and society as a whole. However, with great power comes great responsibility, a responsibility to ensure that financial activities are conducted ethically and do not harm people or the environment. In this post, we will delve into some of the key ethical considerations in finance, such as corporate social responsibility, sustainable investing, and fair treatment of customers. Join us on this journey as we navigate through these complex issues and strive for an equitable financial system that benefits everyone. What is the role of finance in society? In a capitalist society, finance plays a vital role in allocating resources and driving economic growth. However, this comes with great responsibility. As fiduciaries, financial professionals have a duty to act in the best interests of their clients and the communities they serve. This means striking a balance between profit and responsibility. While profit is important, it should never come at the expense of people or the planet. Financial professionals must always consider the ethical implications of their decisions and act accordingly. This can be difficult, as what is considered ethical can vary from person to person. However, there are some general principles that can guide financial decision-making. First and foremost, financial professionals should always act with integrity. This means being honest and transparent in all dealings. They should also avoid conflicts of interest and put their clients' interests ahead of their own. Additionally, financial professionals should seek to create long-term value, rather than simply chasing short-term gains. And finally, they should strive to promote sustainable development, which takes into account environmental and social factors. By adhering to these principles, finance can play a positive role in society by promoting economic growth while still protecting people and the planet. The different types of financial institutions. There are a variety of financial institutions, each with its own unique purpose. The three main types of financial institutions are depository, lending, and investment. Depository institutions include banks, credit unions, and savings and loan associations. These organizations accept deposits and use those funds to make loans. Lending institutions include finance companies, insurance companies, and pension funds. These organizations extend loans to individuals and businesses. Investment institutions include venture capital firms, stockbrokers, and mutual funds. These organizations invest money in a variety of ventures, including stocks, bonds, and real estate. Each type of financial institution plays a vital role in the economy. Depository institutions provide the funds that businesses need to grow and expand. Lending institutions provide the capital that consumers need to purchase homes, cars, and other big-ticket items. Investment institutions help businesses raise the money they need to finance new products or services. The different types of financial institutions are regulated by different government agencies. Depository institutions are regulated by the Federal Reserve System. Lending institutions are regulated by the Consumer Financial Protection Bureau, CFPB. Investment institutions are regulated by the Securities and Exchange Commission, SEC. The ethical considerations of profit. The ethical considerations of profit are twofold: how profits are used and how they are distributed. Profits can be used to benefit the company, its shareholders, or society as a whole. They can also be used to benefit the executives and employees of the company, or to line the pockets of the shareholders. The decision of how to use profits is a balancing act between different stakeholders. The distribution of profits is also an ethical consideration. Some argue that profits should be distributed equally among all stakeholders, while others believe that those who have invested more in the company should receive a greater share. There is no easy answer, and each case must be considered on its own merits. The responsibility of financial institutions to society. In recent years, there has been an increased focus on the role of financial institutions in society. This is primarily due to the global financial crisis, which highlighted the need for reform in the financial sector. there are a number of ways in which financial institutions can be more responsible to society. One way is by promoting sustainable development. This means supporting businesses and projects that have a positive impact on the environment and communities. For example, banks can provide financing for renewable energy projects or green infrastructure. Another way financial institutions can be more responsible is by increasing access to financial services for underserved groups, such as women and small businesses. This can be done through initiatives such as microfinance or responsible lending practices. Finally, financial institutions can also play a role in educating consumers about responsible money management. This includes providing information on topics such as budgeting, saving, and investing. By doing so, people will be better equipped to make sound financial decisions that benefit both themselves and society as a whole. The role of government in regulating finance. The role of government in regulating finance is to protect consumers and investors from financial fraud and abuse, and to promote fair and transparent financial markets. Financial regulation is a complex and ever-changing area, and government agencies play a vital role in ensuring that the financial system works effectively and efficiently. The U.S. government has a number of agencies that regulate different aspects of the financial system, including the Securities and Exchange Commission, SEC, the Commodity Futures Trading Commission, CFTC, and the Federal Reserve. These agencies have different mandates, but all work to ensure that financial markets are fair, efficient, and transparent. In recent years, there have been a number of high-profile cases of financial fraud and abuse, which have highlighted the need for strong government regulation of the financial sector. The Madoff scandal is a prime example of how weak regulation can allow unscrupulous individuals to take advantage of investors. The Enron scandal also showed how lax regulation can lead to corporate fraud and abuse. The role of government in regulating finance is therefore crucial in protecting consumers and promoting fair markets. However, it is important to strike a balance between too much regulation, which can stifle innovation and growth, and too little regulation, which can leave investors vulnerable to fraudsters. The role of finance in society. The role of finance in society is to ensure that economic resources are allocated efficiently and effectively. This allocation must take into account the needs of society as a whole, not just the financial interests of those in the financial sector. The financial sector has a responsibility to balance profit and responsibility, and this requires an understanding of the ethical implications of financial decisions. In recent years, there has been an increased focus on the role of finance in society. This is due in part to the global financial crisis, which highlighted the importance of responsible financial practices. However, even before the crisis, there were calls for more ethical and sustainable finance. The role of finance in society is to ensure that economic resources are allocated efficiently and effectively. This allocation must take into account the needs of society as a whole, not just the financial interests of those in the financial sector. The financial sector has a responsibility to balance profit and responsibility. This means understanding the ethical implications of financial decisions and taking them into account when making decisions about how to allocate resources. It also requires working with other sectors to ensure that the interests of society are taken into account. For example, banks may need to work with government regulators to ensure that new regulations do not disadvantage small businesses or consumers. There are many different views on what constitutes responsible finance. One approach is to consider finance from a purely utilitarian perspective, looking at how it can be used to maximize economic growth or social welfare. Another approach is to consider finance from an